Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, we are going to talk about 50-year mortgages.
Mm-hmm.
We're going to start with this headline here. This is from a news article. Of course, this is kind of new information. 50-year mortgage housing director calls Trump's idea complete game changer. Juana, let's first talk about the history of this. This is not a new idea about having mortgages over 30 years, right?
No, so this is a resurrection of what happened around 2010, and before that, it happened around in the 80s and in the 70s. So this has been an idea that's been bantered around for a long time. So just to go back, the most recent time that this was really seriously considered was around 2010, when people's homes were worth less than what their mortgages were. So the idea was that if people were able to lengthen the amortization of their home payments would drop, and maybe they would not walk on a home that was worth less than what was owed on it. Yep. And they really bantered around this, and what they decided was that if they did that, and by they I mean the government, because remember, the government backs most of the consumer home mortgages, right? So what the thought was that if that was done, then that would artificially push up home prices, which was part of the reason why they wanted to do it. Remember, because homes were worth less than what was owed on them. So because that would artificially push up the value of homes, then all of a sudden people might say, well, now my home is pretty close to market value. Because homes all of a sudden spiked up in value, so maybe I won't walk from it. So the idea right now is that, hey, we're going to take care of affordability by lowering the monthly cost of a mortgage payment, because people tend to be focused on that payment versus what they're actually paying out for the home. The issue with it is what? Well, so take like a 30-year mortgage versus a 15-year mortgage. What happens?
Let's do that. Let's just do that. Let's kind of go through this piece by piece.
Okay.
Because you're kind of just going to cover the whole thing.
Okay.
And we got to take this a little organized. Okay. They did 50-year mortgages in Japan.
Uh-huh.
For the same reason. It was affordability.
Right.
Okay. And that caused real estate prices to increase.
Right.
And why was that? What's the economics behind it?
Right. Just like I said, when you've got affordability, right? So the payments are more affordable because they're stretched out over a longer period of time. That pushes more buyers into the market. Right. More buyers are chasing fewer homes, so that pushes home prices up.
It's not a linear relationship. It's not perfectly correlated. It's not actually very correlated, but it is correlated.
It is, because you're still dealing with supply and demand. If you have greater demand, then that's going to push up prices, whether it's avocados or homes.
Right. Why can't, so the whole thing is like that the government is sort of behind this. Why can't mortgage companies just do this on their own and create it? Like, why does the housing department have to get involved?
Okay. So first of all, these loans do exist. They just are few and far between because they're non-qualifying loans. A qualifying loan is a loan that can be easily sold on the secondary market. The primary buyers of homes, of home loans on the secondary market are, of course, Fannie and Freddie, because the idea behind Fannie and Freddie is to buy these loans and then insert liquidity into the market so that lenders can keep loaning out money for mortgages and different things, right? So the loans that are conforming loans, right, that fit the mold that can be easily sold on the secondary markets are loans that are 30 years or less. So that's the reason why there are few and far between loans that are non-conforming like these.
Okay, here's a little some background info. In the U.S., most conventional mortgages, especially those backed by Fannie and Freddie, are limited to a maximum term of 30 years under federal regulations. Mm-hmm. Such as those established Dodd-Frank. This was back in 2010. This defines qualified mortgage. And and I'm going to leave this up here so you can read it, but this has to do with the amount of risk, because there is this thing called interest rate risk with longer mortgages. That's why a 15-year mortgage has a lower rate. If a going rate for a 30-year mortgage is 30, the 15-year could be 5.5, and the 50-year would be higher. Mm-hmm. What is interest rate risk exactly? Why does the bank have risk when they give you let's say today, a 6% loan? Or I'll use a better example. Why was it a risk for a bank to give you a 2.75% mortgage 4 years ago?
Well, because banks knew that interest rates would go up, and then that money would be locked up at 2.5%, and then they couldn't go out and loan it at 6%, 8%, or whatever rate was the going rate.
Well, say you got a loan a couple years ago at 8%. Why is there still, I mean, they're like, hey, we're getting 8%, we're super happy. Why is there interest rate risk still on the bank?
Well, because again, you have a fixed interest rate, but the bank, is not able to use that money to take advantage of whatever the current market interest rate is. So you've got this 8% loan or whatever it is, but the bank does not have that money anymore to loan out at whatever the current rate is.
If you have an 8% loan and interest rates drop to 5%, you can extinguish the bank's 8% loan. You can say, you know what? Thank you for the 8% money. I'm going to give it back to you. And you go loan it out at 5% because I just got a 5% loan. And now you've lost your 8% loan and you're only getting, that would be like if you had a dividend and they just called you and said, hey, we're only going to pay you 5%, not 8% anymore, right? Because we can get better money elsewhere. We don't need your money.
Right. So in the US, what happens is our loans, most loans are fixed, right? But the interesting thing about us is that our loans are attached to a specific security document, whether it's a home or a car, whatever it is that we're borrowing against. There are other loans in other countries that are actually loaned to you personally, and maybe if you're using that money for a house, you get to take that loan to the next house and that sort of thing. But in the US, we have fixed rates that are secured by an asset, a specific asset that can't be transferred.
Okay, so what we're going to do is we're going to talk about this, what it could do to housing. Economists like Tyler Cohen note it could raise home prices by enabling more borrowing power. We actually have exact numbers or estimates about how many more people would qualify to buy a house. Offsetting affordability gains, if approved, it might start as a pilot through FHFA, Federal Housing Finance Agency, regulated entities. These are the guys who set the rate premiums based on credit score and how much down payment for FHA. There was a big to-do a couple years ago. You can watch the videos we did about it that explains it because they got changed. They get changed every 2 years. Isn't it true, Juana, anytime the government, whether it's healthcare, housing, student loans, college tuition, things like that, they throw more money into the system or they incentivize activity in the system like, oh, now you can get a 50-year loan. You'll pay it off over more years, but it'll be a lower monthly payment. So more people is now affordable. Doesn't that push the price of whatever the thing is, healthcare, college tuition, or home prices up?
Absolutely. Because again, just like I said, you're going to have more consumers chasing a limited number of goods. In this case, it's homes. So yes, it's going to push those up. I think it'll be interesting to see if they maybe have a cap, meaning are they going to do it only for homes that qualify for FHA, because that's a very specific narrow band of homes as far as home values, and if they're going to just experiment with that or if they're going to put it out the broader market. If it was me, I would put it out for a limited amount of time to a specific loan product like FHA and see kind of how that works out, see what that does to the market, and then consider whether or not this was a good idea or not. In
some areas where FHA has a limit.
Right.
So if you're buying $1 million house, you probably wouldn't be able to use this, except you could put 20-30% down and get to the FHA limit and then get the 50-year.
Right.
But you may not want to do that because it'd probably be a higher rate. But here's the question. So, because what's going on social media is, the banks are just doing this to force people into 50-year loans and it's all this much more interest. But it really doesn't work that way. And I'll give you an example. The first example is I'm going to read this. We got some data on this. Based on industry data, now this is 30-year loans. A percentage of 30-year mortgages that actually make it to 30 years is meaning that they're held and paid off via payments without any early termination, which would be selling it, refinancing it, or just paying it off, right? It's less than 10%. I've seen numbers as low as 2%. This is an estimate derived from mortgage service reports and economic analysis, as direct cohort studies are limited. Now, Juana, if my parents 50 years ago, when they bought their first house in Las Vegas, in the 70s, the payment was $300 a month. So a 50-year loan, back then they would say, you're just going to have to pay for 50 years on this. It's the worst thing you could do. But the thing is, if they were still paying $300 a month, still paying off the mortgage, That's a lot less than $2,000 or $3,000 rent they would be paying if they had not bought a house and had just rented for the last 50 years. I mean, they probably had a 3 or 4 year period where their mortgage was more than rents, but all of a sudden rents would have been over $300 and they would still paying only $300. So this phantom, how much interest you're paying over 50 years is kind of stupid when you compare it to the amount of rent you pay over 50 years is going to be way more to the amount of interest you pay back to the bank, right?
Right. So when I bought my first and second house, and I think maybe my third house too, I did the math as to at what point does the mortgage payment go below market rent. And, between these houses, it was about 3 to 4 years.
Okay.
So that meant that for 3 or 4 years, I was paying more in mortgage payment than I would have been paying in rent. But then after that, I was actually in the positive. Now, that did not consider any tax benefits. That didn't consider appreciation. It didn't consider any of that. It just considered just the straight
principal reduction.
Right. It didn't consider principal reduction. It didn't consider any of that. It just considered the straight out cash out of pocket every month. And so I think this is something that people need to understand is, well, it's like with everything else, right? You have to kind of work towards it. And then, if you've ever been on a diet, right? You get on the scale on day 1, day 2, day 5, and that scale hasn't moved. But so long as you're exercising and you're eating better and these things, that at some point that scale is going to start moving in your favor. It's the same thing with this. You just have to kind of put in the time, put in the work, and then the good financial benefits will come your way.
Okay, here's an example that we have. It's a generic example. It's an estimate. Okay, 5% interest on a $500,000 loan drops from $2,684 a month or on a 30-year amortization to $2,392 a month over 50 years, saving $292 a month. So it's about $300 a month less.
Okay, yes, but that's if all things stay the same, and I disagree. All things do not stay the same.
Okay.
So there are two things that will not stay the same. Number one is that you're comparing the same interest rate, and you will not have the same interest rate on a 50-year that you would on a 30-year. So that is misleading. The second part is that, again, what I said before, you're going to have home prices get pushed up rapidly because you're going to have more people entering the market and chasing homes. So again, that is not going to work out with that payment either. So I think by the time you combine those two, will your payment be lower? Yes. Will it be that much lower? No, I don't think it would.
Okay.
So that's kind of my
So you want to be
this.
one of the first people to get one of these. You don't want to wait for home prices to start spiking because here's the thing. Okay, so first of all, Juana, you are right. It's not exactly the same. There's going to be a little bit of a risk of a premium, but remember, it's that higher percentage is not that much more because it's spread out over 50 years. But here's the thing. Here's the big thing that we've got. At 5% rates, a 50-year, this is an estimate, a 50-year-old mortgage, a 50-year mortgage would boost overall U.S. home buying power by 15 to 20%. Across all price ranges. One, imagine you had 15 to 20% more buyers. It unlocks 2 to 3 million additional purchasers annually from the 4 to 5 million sidelined by affordability. So you've got people sidelined by affordability, meaning they have the credit, they have the job, the income, but it's just affordability's out of whack. And what this does is this takes those people, 2 to 3 million annually, sticks them back into the housing market, and then remember, we've got 3 or 4 million people buying houses, and you add 2 to 3 million more onto that, you're substantially, as a percentage, adding more people. And I think you're right. You're going to see the number of people flooding in, going, "Oh, my payment's now $300 less. I'll get in the housing market while I can," and we get back into this pushing asset prices up. Don't you think that's going to happen?
So what I'm hearing you say is that if you're out there looking for a home, you're going to have 20% more competition when you find the right home.
And there are going to be people going, "I'll just get a 50-year loan so my mortgage payment could be less and I can qualify for it. And I'm not as price sensitive now. Before I could only buy a $400,000 house, but now you can buy a $500,000 house because the payment's the same. A 30-year 400 is maybe the same as is a $50,000 or $500,000 mortgage.
Right.
Okay.
But at the same time, just like you said, you can have 20% more people bidding on the same house that you like.
Okay, this has to go through Congress again. And we all know by what we just have experienced, right? Because the Senate just tonight voted on to end the filibuster and vote on the resolution that the Republicans had. Now it goes back to House just to change the date on the timeline for funding for the government. But it's very polarized. It's very difficult to get anything through Congress. And there's a good probability that if it's Trump pushing this and the Republicans voting for it, the Democrats may do the same thing. Oh, we're not going to do it. We're not going to allow it. We don't want, it becomes political because you have a party maybe doesn't want the other party to have a win. Oh, we've got the 50-year mortgage. We're going to push it through. They say, nope, you're not going to do it. We're just going to kill it off, filibuster it forever. So, I mean, this thing is not a done deal, and there's a good probability it may not even, like it won't even come to fruition, right?
Well, I mean, there's just so much out there as far as different proposals that would benefit housing. So to your point, this 50-year mortgage, that would probably benefit certainly some people regarding housing. The other one is the capital gains tax, right?
The exclusion.
The exclusion. That just seems like such a no-brainer. It hasn't been visited in 30 years, for goodness sake.
Oh, at least 30 years.
And so, I mean, Bill Clinton was president the last time this thing was visited. So that's a long time.
Yeah, it was 94, I think. Actually, I think literally based on what home prices have done, the exclusion needs to be $1 million for married couples and $500,000 for individuals. There was a proposal by Lindsey Graham or someone like that to do that, to literally change it, like hard change it, and then index it to inflation. Mm-hmm. And it never got,
right.
No one wanted to do
right.
it.
So there are just so many things out there that would benefit housing, that would benefit people. The issue is, I don't care which side of the aisle you're on. Politicians care more about themselves than they do about us.
Yeah. Well, but I mean, the bad thing is you could get a situation where they all go, no, we're not going to do it. And then the next election flips over and they go, oh, now we've got this great idea we just came up with. We're going to do a 50-year mortgage. And we're going to because the thing is this, based on how this would probably roll out, this is mostly going to benefit people at the bottom end. But it's going to push home prices up at the bottom end too.
It's going to push home prices up throughout.
Think so?
But I think it's going to be felt most on the bottom end.
Okay. All right.
Okay?
Yeah.
All right. So let us know what you think. We are not political in this. We're just observing.
No, we're just explaining actually what's going. I mean, you can't, having gone through like what's going on with, SNAP and with airlines and airports and ATC and government funded stuff, understand that anything that happens with government affects us. And when government doesn't cooperate, and then things get proposed sometimes that are good, maybe they're good. I don't know if this is good, to be honest, because like a lot of you would be like, hey, this is great. I own a bunch of rentals. And if they end up going up in value because this thing's pushing us home prices, that's good for me.
Right.
Yeah.
So, I mean, I think it will push home prices up for everybody. And I think in the short term, it'll help some people. In the long term, I think it's going to push home prices up for everybody. But remember, when you're buying a home and home prices have gone up, that is not part of the inflation index because that's a durable good.
It's an investment.
That's right.
It's an investment, yeah.
So anyway, leave us your real estate related comments. Please remember to subscribe, hit the notification bell, share the video, like the video, and we'll see you on the next video. Bye.
Bye.